Thank you.
Jenny. Thank you very much for coming back to the event, and many thanks for people joining us online. That's a very nice round of applause. I think, we should give that to ourselves who made it in person despite of the weather. Well, we're here for a very important discussion. I think earlier we discussed a lot about many issues. I think we can really move to some of the emerging area that is actually still underfunded, if I put it, summarizing one word. We know the sheer volume of sustainable bonds and loans that we see in the market globally. And I think it's fair to say that these instruments or these markets are functioning pretty well without too much intervention year to date. If I just look at the bond market as alone, we have already exceeded $5 trillion globally in roughly about over 10 years' time, right? But as much as we love green bonds, there are also very difficult issues that we need to tackle. If I name a few examples, climate adaptation. Today is an immediate reminder that climate change is real. We have been hitting more and more typhoons and TAs and black rains, in recent months in Hong Kong. Coral protection, for those who are in Southeast Asia or in Australia, reforestation, even access to clean water, education. These projects tend to have that public nature and therefore not well funded, by the private sector. And they might not have the same sort of profitability profile like, some other very large-scale infrastructure projects. So this means our mainstream finance and investing industry really need to rethink with innovation and with the can-do attitude to unlock capital to address some of these very challenging and much-needed areas. So on stage, I have a great mix of speakers joining me to share their perspectives. Their profiles are online, so I won't go into their CVs in detail. And they are industry veterans, and you have seen them on many stages, in Hong Kong or elsewhere. I want to address the first question to Ritesh. Can I pick your brain a little bit on the current landscape when it comes to the development of blended finance? And maybe you can help us to define what blended finance really is. And what are the trends that you are seeing that excites you or frustrate you in Asia?
Thank you so much. And just a very quick introduction about Convergence for people who don't know us. We are a global network for blended finance. And we essentially do four things. We guide the field on the topic of blended finance, so we have the data, so we have the evidence. We essentially focus on educating, capacity building. We also connect and then also focus on mobilizing. That means bringing the pipeline of transactions out into the market as well. So coming to the definition of blended finance, I think there are a few definitions out there, as we all know. And I think the way we define blended finance, and which is one of the most widely accepted definitions as well, is how do we use this very limited pot of development capital, which typically comes from overseas development assistance funds, which is typically developed countries, from MDBs and DFIs, and also public finance and philanthropic organizations. So how do we use that in a very strategic way so that we can alter the risk and return profile of projects or investments to really make them more bankable and investable, and thus mobilize mainstream private sector capital at scale at market rate. That's essentially what blended finance is in very simple terms. In a nutshell, for folks who have been working in the world of finance, it's structured finance for good. That's it. In terms of key trends, what we are seeing essentially is overall blended finance market globally is around $260 billion US, out of which around $51 billion is Asia Pacific, nicely split between Southeast Asia and South Asia, 25 billion each. Overall, year on year, we see around $4 billion of aggregate financing happening and around 20 to 25 deals every year. So it's a very steady growth. We haven't seen a lot of decline. It's been gradually building up. So that's good news. Since you mentioned about mitigation and adaptation as well, we tend to see most of the focus on mitigation, almost 60%. However, we are seeing an encouraging trend in cross-cutting deals as well, which means how do you bake in adaptation within mitigation? And I think there was a reference of that in the earlier panels as well. Which countries? We are seeing Indonesia, India, Philippines, Vietnam is where most of this is happening. And in terms of sectors, it's been broadly clean energy, financial services, more towards MSME financing or microfinancing as well, and then also infrastructure with a bit of a promise on agriculture in last few years, but it still is very underrepresented in Asia as well. Yeah, and in a nutshell, we are seeing a lot of project finance structures, a lot of aggregated formats like funds and facilities, and also a growing interest in sustainable bond market as well. I know you asked me to throw a bit on what are the challenges and frustrations. I don't know if I have time, maybe, or I hand it back to you.
I think you can elaborate a little bit.
Maybe just very quickly, 30 seconds.
Yeah,
I think what we are seeing as one of the biggest challenges, a few biggest challenges in the world of blended finance. One is, of course, it takes a lot of time to get all these stakeholders together. So there is a lot of lead time to get a structure out. Also, many blended finance transactions tend to be very bespoke. So we are really focusing on standardization, and I'll try and touch upon that in my next question as well. Yeah, so I think those are broadly areas. We also see challenges around currency volatility. So how do you cover for foreign exchange risks? Also political risk, but also there's a big challenge on capacity as well. So these are some areas of challenges which I'm happy to dwell on where the opportunities are later.
That's great. I mean, then I can easily turn to Li Zong, one of the very prominent Chinese banks. We also have Emily, one of the biggest asset manager, not one of them. And maybe we can, turn to Li Zong first. Based on, the steady growth of this market and also the challenges that Ritesh just shared, how does a bank like CITIC capturing, this opportunity?
Sure. Thank you, Huang Zong. Maybe just a quick introduction of myself. I run the global market business for Citibank. I think we are very actively involved in all the green bond and green loan and also ESG framework drafting for our clients. To answer your question, I think, yes, we are capturing those momentum. I think as many of us know that in many cases, some of those projects with very positive climate impact, sometimes they do have a bit more difficult nature that make it a little bit difficult for commercial banks like ourselves to be involved. For example, many of them has a relatively longer investment horizon, a complex risk, and sometimes they do come with a relatively lower returns. And for banks like ourselves, in the past, or rather, the commercial bank's nature that require us to invest in projects with a stable cash flow or certainty on repayment or refinancing, and all this nature make it a little bit difficult for us to bank those projects before. But I think with the blended financing, I think we can or are able to partner with institutions with different natures, the likes of BlackRock, where the commercial banks in general want a lower risk profile. At the same time, our return or our requirement on return are relatively low as well. We partner with institutions who have a relatively higher return target, but at the same time with a higher risk tolerance. Those include the likes of those security firms, fund managers, PE firms, family office, and also in some cases we can partner with those development banks or local government who have a longer investment horizon. Through those partnership, I think we can make those projects with a positive climate impact at the same time with a little bit complex risk profile be more bankable for commercial banks like ourselves. I think the last small bit worth to mention is that to form a sustainable partnership between banks and PEs and many other institutions. I think one is there needs to be a mutual trust. Secondly is we need to have a similar and high standard of the climate-related considerations for us to be able to form a sustainable partnership and also to avoid greenwashing of some of the projects.
Thank you. I think you touched on a very important aspect, which is partnership, right? Because, you know, with the projects that we come across in the blended finance world, they are not your typical vanilla projects that banks know what to do, you know, as a BAU. So that actually brings me to Emily. It seems to me asset owner is also very important in this pixel. In fact, asset managers need to come in to the rescue to support blended finance. Can you share with us your conversations, experience with institutional clients? You know, what's their appetite, you know, in this space? Is there sufficient, you know, investment appetite at scale to address bankability that, you know, Li Zong just shared? Yeah, that would be great.
Sure. Thanks, Gianni. Thanks, everyone, especially those who actually managed to make it here despite the circumstances. So the short answer to your question is definitely yes, the appetite is there. But our clients are generally seeking help to navigate some of the associated complexity with that. So many of our largest institutional asset owner clients share the same view that we do, which is that the low carbon transition is a mega force that will be driving economies and markets for decades to come. But that transition is not going to be linear. There's going to be risks and opportunities and bumps along the way that they need to navigate. So just as a reference point, about 80% of our top tier clients in the APAC region have some kind of climate commitment. So that's everything from integrating it holistically across their whole portfolio, from the top down in their strategic asset allocation, in the core of their public markets portfolios, all the way through to allocating to innovative vehicles in private markets. And really, it makes sense, right? Because they're very long-term investors, and by our estimations, the amount of investment that needs to go into the energy system is going to double from about 2 trillion a year to 4 trillion a year. About 40% of that is going to be needed in infrastructure. And clients are definitely getting more and more interested in investing in infrastructure. It really is well aligned with government incentives and with voluntary corporate commitments, but it also provides a lot of alignment to this increasing focus on things like energy security and resilience as well. But clients definitely need a lot of help tapping into that pool. The energy transition is complex, even more so in EM and APAC, and actually only about 11% of the infrastructure spend in the last 5 years has gone into emerging markets, including Asia. So our clients see the opportunity, they're excited about decarbonization potential, and many of them, as part of their climate commitments, they have actually got some kind of dedicated capital pool that they've carved out to allocate to transition solutions or impact. But the reality is that to date, the majority of that capital is still being deployed in DM rather than EM. And the reality is that the risk tolerances of large traditional investors have not yet been built to allocate to emerging markets at scale. So for many of them, it's still not a big part of their asset allocation, especially in private markets. So their risk return expectations have aligned to that of the US and Europe, and they're holding back from allocating to emerging markets because of both perceived and actual risks around currency convertibility, sovereign risk, depth of capital markets, perceptions around bankability of projects. So if I could share a couple of points, you know, we're now in market developing our second and third large-scale blended finance fund. And a couple of learnings from that from us. In order to meet client needs and get capital to where it's required in these markets, you've really got to rethink how you package risks in these markets. Because even though clients might want to allocate to this space, they've still got internal hurdle rates that they need to maintain, and they can't compromise on that. So we have to deliver them a commercial risk return profile that looks and feels like what they're used to, and that can sit alongside their existing asset allocation, rather than something that feels really, really niche and funky, that's a little bit difficult to get everybody internally aligned on. So for example, if you're developing a blended finance debt instrument, the more that you can structure that so it looks like something IG that would sit alongside existing IG allocations, that's the difference between a token allocation and a scale allocation from their balance sheet. And that opens the door to being able to build those new capital markets and to be able to kind of reduce some of that perceived risk over time. But as we've kind of touched on already, it takes a lot of strong partnerships across the public and private sectors. So we do see opportunities for asset owners to allocate this patient, flexible, long-term capital. So for example, our insurance clients are really keen to allocate to resilient infrastructure in emerging markets, which makes sense, right? Because that aligns with their own balance sheets. So we launched a blueprint with the Insurance Development Forum in April last year to develop an infrastructure resilient debt fund into emerging markets. You've also got pension funds who are looking to increase their exposure to real assets. You've got sovereign wealth funds who are looking to use these types of platforms to channel capital into areas of strategic importance. So look at what Singapore is doing with their blended finance FAST-P platform, which we're also supporting as well. And even banks, like you mentioned this already, but banks want to partner with these types of initiatives because it helps them to recycle capital in those geographies as well. So yes, very, very long way of saying there is appetite, there is dry powder among the asset owner base, but the more that you can package that up and the more that you can structure it to fit their existing asset allocation, the better that scale is going to be.
Yeah, absolutely. I think that's really right? We need to actually turn this product into something that is very compatible to what they already know in the marketplace, like IG, like development markets. Even, we talk about climate adaptation a lot today during lunches as well. But, if we put it into simple terms, it's actually making your physical assets resilient to withstand all the extreme weather events that we're seeing more and more often, as an example, right? So I think we need to use the sort of industry language to tackle the mission that we are facing. Thank you, Emily. Actually, Katie, would love to pick your mind about the other type of asset owners, right? Because we just heard from Emily about, the institutional side, from pension funds, insurance money, sovereign wealth, and also banks, right? What about the family offices? Because you operate in that environment. It'll be good to hear, family offices and how they see innovative funding mechanism to support, some of the projects that we talked about earlier.
Sure. So happy to chime in. Just a quick one-liner. SFI is an APAC-focused platform, and so over time we have around 100+ family offices, private wealth individuals that are part of our platform. And our mandate is very much to mobilize them to invest into blended finance and innovative mechanisms. I would say that this topic is definitely in their radar screen from the get-go because of the additionality component. And if I were to kind of encapsulate our observations of the status, interest is building. I think we found at SFI the deal flow is getting more interesting in terms of quality and APAC focus. Action-wise, I think it's catching up. So I try to be positive as well. If we compare to 5-10 years ago, we are seeing very interesting participation from some family offices and foundation. So there are pilots that ought to be amplified. So I will elaborate a bit on why interest is building. So with some sort of data points, we just conducted a survey in May with 144 family offices. One question is specifically around their areas of thematic focus that interest them. And surprisingly and interestingly for this year, nature-based solution, biodiversity, and regenerative practices came up at the top. Now, we also think that, followed by food and ag and healthcare. I think what we're picking up in terms of signaling is there is curiosity and there is interest and there's understanding with the typhoons and climate risk, that it is getting top of mind. The policy signaling is really important. We've been in roundtables with Hong Kong MA on this topic to capacity build, FAST-P in Singapore and all that. That helps. The action is catching up, if I can zone in. So at our summit that we sort of do every year in May, we had a panel that was specifically focused on this topic. And I think the challenges of what needs to happen, to Ritesh's point, is for family offices, sorry about that, and it's heartening to know institutional investors are also needing to get up to the learning curve, the same for family offices. So there is a challenge of the capacity and the sort of getting up to speed. And so the insight there is we want to change the mindset that instead of learning all the way, you don't really need to know everything. It's learning by doing and participating in some pilots. So that was one insight that some of the families who already are in these innovative mechanisms are sharing with the other family offices. The second challenge is the perception of smaller pilots and deals that are in the region that becomes very chicken and egg. Do I participate? Do I not participate? And so the encouragement and nuance that some of the families are sharing is small can be beautiful too. It's chicken and egg. So even a modest amount of catalytic capital, you can have an outsized ripple effect, especially in this region at this point. I want to end on a positive note and share maybe 2 examples of some of the deals that we know some of our family office members have participated in. One is in the oceans and fisheries space. So this year, a sort of small-scale fishery impact bond in Indonesia that's led by RARE was launched. And it's involving 100,000 hectares of marine protected coastal sites in southeast Sulawesi. And it's piloting community-led co-management of small-scale fisheries. And the outcomes, of course, is sustainable fisheries, increase fish biomass. The financing was around $6 million, and it crowded in investors from foundations, DFIs, and family offices. Some are notable ones: Minderoo Foundation from Australia, Rumour Foundation, who we know from based out of Singapore, Builders Initiative in the US. And investors that provided this upfront capital for conservation activities will get repaid in interest if RARE achieves all these outcomes. So again, I think these structures are in place. They are additional because they're addressing a very underfunded target market, and also they're crowding in risk-adverse, government budget capital as well. The other one, which I think we have representation in the room, is ADM Capital. Their Asia Climate Smart Landscape Fund, which is in the private credit space. So they're filling the gap of Indonesian SMEs that are engaged in sustainable agriculture, land regeneration, and forest protection. And there's a guarantee in that with Rabo Foundation and some DFIs. From the family office side, we've got RS Group in Hong Kong and MacArthur Foundation and Packard Foundation. So I think ending on a final note is SFI is doing our part. So in Hong Kong, we see that the Blue Oceans theme is picking up in the region, especially in Singapore and now in Hong Kong. Yeah. So what we're doing next week is we're bringing some of the Hong Kong family office to Singapore for a closed-door workshop to learn also what are the projects that they're happening, learn the capacity technicalities. And in October, we're co-hosting an ocean innovation platform as well with Monaco Foundation to showcase some of those solutions as well. So I'm very optimistic that we'll see more.
That's fantastic. I think you have mentioned many living examples of how you can actually crowding the philanthropy pot of capital to support, this area, which are transitionally just being done by banks and asset managers. So it's actually refreshing to see many of these interests, real interests, going into the right places. I would love to encourage the audience to send in your questions through the QR code. I think Jenny gave the instruction earlier. We already see some questions. Maybe we can just take a pause and answer some of the questions so that I don't overly abuse my moderator's role. I'll pick a couple. Are there innovative private green financing that are impact-based green finance that don't require to tap into physical reserves of public sector? I think there are plenty. I think some of the examples that Katie mentioned are just purely from the private sector rather than from the public sector capital. But Emily, examples of the fund that you're running?
I probably can't name names in this forum, but I will say that there's a few ways to think about that, because one is there's plenty of examples in developed markets for one thing, because they're already a proof of concept and they can already stand on their own without that catalytic capital needed. Another thing I would say, as Katie's talked about already, is you don't necessarily need the public sector fiscal reserves if you can mobilize philanthropic money. And I think kind of there's so much potential there for tapping philanthropic money, and I know this is something Ritesh feels very strongly about as well. And then I think the third thing to think about is the whole point of blended finance is that you can use blended finance in the early stages in order to build a market and build confidence in a market such that you don't need the public money anymore. Like if you're going to need the public money into perpetuity, then it's not really serving its intended purpose. Whereas if you maybe use it for the first or the second vintage of a platform, then eventually you should need less and less of that public money over time, so that you can actually recycle it into other places.
Well
Just
said.
a couple of things.
Yeah, well said. Anything to add?
No, I think it's an excellent point what Emily mentioned. I think one thing is very important to realize, that the use of blended finance is of it being used as a transition tool, right? So you're trying to make something which is not commercially viable today to eventually making it commercially viable over a period of time. So that's where we use these scarce development finance funding, which either comes from public finance or philanthropy or ODA funders. To use it very strategically is kind of very important. And we've seen, honestly, across sectors where private sector have led initiatives, and there is very limited requirement for public finances to kind of join as well. So there are examples all throughout, right from conservation to healthcare to agriculture, etc. But especially the biggest challenge is that if you look at most of these sectors, in developed countries, they are anyways funded by private sector. It's the situation in emerging markets which makes it very challenging, and that's where I think the application of blended finance supports that transition. It establishes a track record, it establishes a risk which private sector can put a price on, and which then makes it possible for commercial entities to kind of deep dive into as well.
Great, thank you. There's actually a question about the role of carbon credit. Does it play a role in the blended finance world? Anyone?
I can take it, but
yeah.
I mean, just a very quick one. Especially, we are seeing a lot of carbon credit-driven models around nature-based solutions. However, of course, we know the state of where the carbon market pricing, it's still in a very evolutionary phase, and that's where I think one of the things that we are recommending or suggesting to project sponsors and fund managers and the likes is to really look at more diversified revenue streams rather than having 100% reliance on only carbon credits as a revenue stream, which then kind of can build more confidence into these models over a period of time as well. So I think especially when you're looking at conservation or nature-based solutions, you definitely need to have some form of carbon financing for sure. Yeah.
Great, thank you very much. Thank you very much for the questions. Keep them flowing in. I'm gonna go to my second round of questions, and we should still have time to pick up a couple of questions from the audience. I want to change the direction a little bit. We spent quite a bit of time on blended finance. I think we need to talk about risk management. It is very frequent now, what's happening, right? So we'd love to just hear from my panel about the role and evolution of climate risks management in banking, asset management, for family offices, right? Maybe I'll start with Li Zong this time. Can you share with us, what's happening with climate risk management in the banking sector, and specifically its implication, for Chinese banks?
Sure, thank you. I think what we see is that the climate risk management has evolved from previously a more compliance-driven to now strategic risk management tool that helps the banks on their daily operations. I think for banks, for commercial banks like ourselves, the first focus and objective is obviously to control or avoid undesired climate risk exposures. So in the past, we have integrate the climate risk considerations into our risk management framework. For example, on the project basis, when we provide financing, we assess the project whether there is too much of climate risk. On the portfolio basis, we also assess the entire portfolio's physical risk based on the geopolitical locations. On the bank-wise, we periodically we monitor closely on the regulatory policy and industry development of the climate risk management to ensure that we understand and monitor our climate risk management framework. I think secondly is that how do we support and fulfill our clients' needs, but at the same time maintain a reasonable level of the transition risk exposure. I think what we try to do is that for some of the companies that with relatively high climate risk, but they have showed credible transition potentials. For this kind of clients, I think rather than just exit them early, we actually help support the client in terms of continue to support them. At the same time, help them transit into a low climate risk business model, so that in this way we help and support our clients at the same time maintain a relatively low climate risk and transition risk exposure. Lastly, I think for Chinese banks like ourselves, I think we pay more attention and we put in more resource into climate risk management. As China has announced the dual carbon goal 5 years ago, and those goals are actually very ambitious. That requires drastic transition of economic growth model. And also as a Chinese bank, I think Citibank is devoted to putting more resource and commitment on the climate risk management and transition of the model. And it does require a much higher standard of the climate governance to help China to achieve their dual carbon goals. I think that's particularly important for Chinese banks.
I can see you must be very busy. Emily, for an asset management your size, share with us the latest climate risk management, but importantly, how do you use that to identify investment opportunities?
Sure. Now, given our size and our number of products, I think we'd be here all day if I tried to do that justice. So for anyone who's interested in more detail, we do have a 38-page climate report, which is publicly available. And there's all sorts of detail in there on our risks and opportunities and strategies.
That's not bad, 38 pages only for size yourself.
Look, we as an asset manager, we're approaching climate risk and management in two main perspectives, right? One is, as a fiduciary, when we're thinking about how to help clients who are interested access investment opportunities, but also discharging our fiduciary duty in terms of managing material risks where it's within the bounds of our clients' guidelines. And then secondly, obviously, as a corporate entity who is also impacted by the risks and opportunities of climate and also can have an impact on the climate. Now, given that the first one is multiple times bigger in our case than the second one, I'll focus on the first one, because as a fiduciary, our role is to really help clients achieve their investment objectives, right? So we have to start by listening to their goals, offering choices that meet those goals, providing the best possible performance within the bounds of the guidelines that they give us, and underpinning all of that with research and data and analytics. So in the case of how that plays out in terms of climate risk management, you really need a very integrated framework that allows you to be able to deliver that across risk management, across research, across technology, stewardship. So maybe I'll walk through some examples of those things. So when it comes to risk management, the management of material risks across our investment platform is taken care of via a 3 lines of defense approach. The first line of defense being the primary owners, who are the investment teams and their business management. The second line of defense being our platform-wide risk management function. The third being our internal audit. And then all of this is overseen from the top down by both our board of directors and our global executive committee. So very comprehensively weaved throughout the organization where it actually makes sense and is appropriate for that investment portfolio. The second spoke to that wheel, if you will, is really about research. So when we're looking at trying to get the best financial returns for clients, we're really taking a research-based view of economic development. So that includes our view of how we expect the low carbon transition to unfold and the extent to which it's already priced into financial markets, which it may well be. So this is the foundation of our decision-making process. And so we invest quite heavily in our research capabilities. Again, I would be here all day if I called all of them out separately, but a couple of the more centralized ones. So we have a sustainable investment research and analytics team, which sits in our macro think tank, which is the BlackRock Investment Institute. Now, they developed the BII transition scenario, which is our house view of how we expect the low carbon transition to unfold. And that model is actually embedded in our capital market assumptions, and it also helps us to identify opportunities that might be mispriced or misidentified by markets as they stand. That team also develops a proprietary sustainability scoring framework called BSI Intel, and that enables them to assess companies on the basis of how well they're managing material risks, as well as how they're capturing opportunities. And we can use that framework to create customized portfolios for clients to meet their unique needs, which are very different from client to client. I think the third thing is technology. So obviously we are also, as BlackRock, a provider of technology solutions. We have had Aladdin for a long time, which is providing sophisticated tools and analytics and portfolio insights. And as part of that, we had demand from clients to also be able to assess climate risks and opportunities through that platform. So we developed Aladdin Climate that helps to actually provide climate risks in financial terms, in terms of risks and opportunities. So helping to bring together climate science, policy scenarios, asset data, financial models all together to provide climate risk valuation and adjusted risk metrics. And then the last thing I'll say that's also really critical to that, and all of these things help us gain insights that feed both investment decision-making, but also product innovation. The last thing is stewardship. So stewardship being the link that sits between our clients and the companies we invest in on their behalf. They're obviously building constructive relationships with corporates all day, every day, to help encourage the corporate governance practices that create long-term value. And that helps us make more informed voting decisions. It also improves disclosures that can then help the whole market make more informed investment decisions. So all of this, it can't just be sort of pockets activity here and there. It really needs to be a very integrated framework to be able to deliver the best possible investment outcomes as well as product innovation across all of those different things.
It's very comprehensive. And you just gave me an idea. I'm going to invite the SI intelligence to join our HKGFA working groups and share their intelligence with our members in the future. Katie, can I ask you the same question? Can you share with us what the asset owners are thinking, family offices are thinking when it comes to climate risk management of their portfolio?
I'm reflecting on Emily's response, and I think my reaction is that's like the Ferrari of risk management. It's very comprehensive. I think family offices at this point, as you know, a lot of them are going through generational transitions. So by function of that, I think what we can see is even across the different generations, the perception of climate risk might be very different. So how it turns out in investment portfolios, we see it more reflected from a value creation and a diversification type of expression rather than a let's go fully robust, risk-proof our portfolio perspective. And I'll give a few examples, right? So, for example, there's a venture fund that is backed by a real estate family in Hong Kong called Fabrica, and they invest in venture solutions and venture funds in the agri-tech, the food tech, and the material tech sector. And so they would use frameworks like the planetary boundaries by climate scientists to help them determine investment decisions and lead them to invest in more upstream solutions. So that really impacts them from a more of a what type of thematic and which part of the supply chain should they be focusing on. From a portfolio perspective, I mentioned value creation and diversification. They may not be having all these in-house tools. The reality is they probably would pick fund managers and asset managers that have those, and through an engagement process, ensure that the fund managers are talking to the portfolio companies from a stewardship perspective and highlighting, making sure they're compliant or, you know, getting to those targets. But it's come out and also uncovering some climate adaptation types of new products in the public equities and the debt space that are starting to look interesting for these families. And also some would go as far as invest in carbon capture technologies, green hydrogen technologies. So there are some examples like that. And finally, with what we observe is climate risk assessment tools. There are many sort of existing providers, but also new and upcoming ones. So once in a while, we'll see opportunities to invest from a venture perspective to back those companies. And finally, a lot of family offices in these regions, actually they have a live operating business, whether it's real estate, whether it's shipping, hospitality. And so climate risk assessment definitely is front and center from an operational perspective, and they're capitalizing on that in accessing transitional net zero financing opportunities. And from the innovation side, I would say it's a little bit more adoption rather than, you know, investing in those technologies.
Great, thank you very much. I think you're not too far from a Ferrari. I think I probably should use the EV analogy rather than a Ferrari here. Ritesh, based on the views just shared, I think I started the panel with you. I'm going to end the panel with you with about 3 minutes left. So how can converge the climate risks views, the investment appetite that we just heard, and reflecting the project complexity that we talked about in the beginning of the panel, you know, how could converge, you know, help to bring everything together?
Yeah, well, thanks for that. And it's definitely a difficult one, which everyone is trying to crack. And we don't claim that we have the solution to that, but we are attempting in that direction. So one of the ways which I kind of talked about was also about how can we make this more comparable. In fact, that came from the panel as well. How can we make this more standardized? Because one of the challenges that we are seeing in the world of blended finance is that it's too bespoke. It takes a hell lot of time to get a deal or a transaction out. So the point which we are trying to move towards is how can we move towards standardization? How can we make blended finance boring, scalable and replicable so that people understand it and then they can just replicate it n number of times. That's what we want to see. So we are going into a bit of a anti-innovation drive, let's put it that way, in the world of blended finance, in form of coming up with 10 to 12 models that we've seen that have worked when it comes to scaling. We house the data for blended finance globally. We have, this is at the back of some 1,600 plus transactions that we have, plus of course a lot of market consultations that is going into this. So we hope to kind of give some clarity to the field as well on what those 10 to 12 models could look like, essentially targeting, you know, key problem statements like, you know, how can we have a more strong project pipeline or investable pipeline into the market, which is addressing into the field of sustainability. How can we have more increased investability for projects as well as at a fund level? We want to see more aggregation. That's another way to mitigate risks as well. Third is really how do we focus on driving more domestic capital mobilization. We all know what's the state of global markets and where cross-border money and trade is moving. So I think there is potential in Asia to do more within the region, but also at a country level as well. And then the last one is really around mitigating the foreign currency risk as well, because that tends to be one of the biggest challenges in the world of blended finance. The hedging costs tend to be so high because of currency volatility. It becomes very challenging in that direction. So those are some ways which we are looking at. A couple of other projects that we are working on is, one is on the insurance side. So how do we bring insurance companies into this area in terms of mitigating risk? And so look out for that. We'll be coming up with more on that shortly. And then also we are developing a framework for blended finance, which supports regulators and policymakers to think about what an enabling environment for blended finance could look like for emerging markets. So I think I'm right at time. That's some ways in which we'll try to converge.
Excellent. Well, thank you so much, panelists. You have done a stellar job in answering my questions as well, the question from the floor. Right bang on time. But I'm going to conclude. I think the panel here actually have answers to many of the questions, many of the issues that we face, right? If you're a project owner, coral protection, reforestation, whatever that is, come to CITIC, for origination opportunities. If you are philanthropy and you don't know how to use your wealth for impact, go to Katie. If you're institutional, Emily has the solution for you. And if you have a lot of intellectual questions about blended finance, we have Converge here for help. And this is what HKGFA is about. We want to bring everyone together to find solutions. With that, I want to end the panel, and thank you very much for your attention.